And I'm just going to dive in and we'll make up some time here. I want to thank our sponsors. Our sponsors are the institutions that make these programs possible. And as a public institution, a public university, we couldn't do these without them. So we are most appreciative and grateful to them. Our principal sponsors today are RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Pacific Western Bank, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Comerica Wealth Management, Hathaway Dinwiddie, Scott Work North America, U.S. Bank Private Wealth Management. At the bronze level, Hanmi Bank, HDR, Shawmut Design and Construction. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, the Federal Home Loan Bank, San Francisco, and Tudor Perini Corporation. And our academic sponsor is UCLA Extension. Many thanks to all of our sponsors. Our program today will begin with the forecast. We're going to start with David Schulman, our own David Schulman. I think many of you know him, but David earned his PhD in finance here at Anderson, was a distinguished professor at University of California, Riverside, our sister institution, and then was with the forecast, then went to Wall Street and came back to the forecast about 17 years ago. Has retired many times, I think, but is back with us again, showing you that retirement does not last. And David is going to talk about the landscape in the finance sector. And then I'm going to follow that with the U.S. and California forecast. We're going to have at 10 o'clock our keynote, and we actually have two keynotes. One is Chang Liu, the president and CEO of Cathay Bank, and the other, Teresa Basmore, who is the president of the Federal Home Loan Bank, San Francisco. And then we're going to have our break after that, and then we'll turn to the panel. So let's begin with David, and we're going a little fast to make up time, but now I think we made up time, so it's all yours, David.
I guess I flunked retirement.
Oh. Notice David has his
Fire department, I'm ready. I put out the fire. At least I tried to anyway. What I'm going to talk about today is not so much what's going to happen on Friday's employment report, what's going to happen to the stock market next week or even next year. Same thing with interest rates, but I want to look at a longer term view as to what I think is going on. And I'm going to argue that we're in a new world, and that began in 2022, because I think we've had a whole series of going back over 100 years of 13-year economic cycles. And we're about to enter a new 13-year cycle. And the three the cycles, the first one is 1918 to 1931. That sort of sets the clock. You have the roaring 20s, you have electrification of the economy, automobiles and radios, and there's a stock market boom and a crash. And the thing is prior to then, after every major war the United States fought, there was a post-war depression. And I use 1931 for the post-war depression when that hits, is because 1931 was the year that the Great Depression became great. Before that, it was a recession. In 1931, it became the Great Depression. So the cycle starts at 1932 to 1945. You have a much different economy than you had in the 1920s. You have the Depression in World War II. You had huge government intervention in the economy, both to deal with the Depression and also to deal with Second World War. You had the formation of labor unions, and you had the establishment for the first time of a national social safety net. So that was a totally different era. It was characterized by intense government intervention in the economy, indirectly, mostly the New Deal, and very directly with World War II. The next 13-year cycle is 1945 to 1958, and that's a much different era than the Depression, World War II era. It's a transition from a World War economy. It's cars, housing, defense, and there was fears of a new depression. Because after World War I, remember, it was 13 years after World War I, we get the big depression. 1958 is 13 years after World War II. And there was fear that the 1957-58 recession was the start of a new depression, because it was followed, that was the historic pattern of the United States. There was no depression. And fiscal policy reigns. And basically the world believed is through fiscal policy, we could control the business cycle. And all of a sudden we had the soaring 60s, and we ended up with the end of the 60s with an inflation. So that was a different world. The late 50s into 1971. Now here I cheat a little bit. I started 1968 to 81. And that era, you basically had, all of a sudden you had stagflation, where the Keynesians believed you couldn't have inflation and unemployment at the same time. We ended up with inflation and unemployment at the same time. There were oil shocks, and it was sort of the heyday of monetarism. In fact, at the end of 1967, Milton Friedman makes his famous address to the American Economic Association, which basically says there's no long-run trade-off between unemployment and inflation. And that rings true given what was going on in the 1970s. So that was a totally different world from the 13 years prior to that. You then end up with Volcker breaking inflation, the 82 to 95 period. Volcker breaks the inflation. It's a different world. You have Reagan tax cuts and a stock market boom. But the thing is, during 82 to 95, the big fear in the economy was not worrying about having another depression. The big fear was renewed inflation. So the market, that's when you had the term bond market vigilantes, where any sign of inflation came, the bond market would sell off. So there was great concern about inflation. 1995, next 13-year cycle, 1995 to 2008. In 1994, Greenspan preempted the inflation. He raised interest rates substantially from 3% to 6%. It was the heyday of the Fed, where basically the Fed could do no wrong. We had a dot-com boom. We had a housing bubble boom. And we also had during that time the full flowering of what we call globalism, where international trade, international capital movements totally thrived. And it was really, it was a great moderation, where basically is no inflation, no depression. And it was sort of what people call the Goldilocks economy, a term actually I invented back in 1992. And that was sort of the era of the Goldilocks economy. But then boom, next 13 years, 2008 to 2021, we have what was called a Minsky moment, where the markets crashed. All of a sudden, all these securities that were created, all of a sudden blew up. I have to plead guilty. I was an inventor, has played a small role in inventing some of those securities. You had a market crash. We had quantitative easing. We had a zero rate fiscal policy. Zero rate monetary policy, where basically the Fed lowered rates to zero and kept them there. There was an all-in fiscal policy in 2009, and then it went on steroids with COVID in 2020 and 2021. So basically the government threw everything but the kitchen sink at the economy. And that era, those last 13 years, zero rates, but very active fiscal. I mean, that area is coming to an end. So where do we go from 2022? If this is right, where do we go from 2022 on? So I think about interest rates are normalizing. I don't think we're going back to zero rates. We're deglobalizing. We're onshoring We're onshoring activity. There's rising labor costs in the system, and you have to witness, the auto contract, airline contracts. And in general, wages have been much higher. We're going on an energy transition, and we got energy hardening the economy to deal with the climate change. Much higher defense spending. Bob Gates, who was the CIA director and the Secretary of Defense in several administrations, basically said the United States faces the most dangerous threat environment in his lifetime right now, given Russia, China, Iran, and North Korea. And so defense spending has to go higher. We will still have high budget deficits. And in my sense is inflation doesn't go back to the 2% that the Fed is worried about. So that to me is one of the critical questions. So I think what we've experienced in the last 13 years, up to 21, and even going back to 95, that's over. Now, if you don't believe me, Michael Smolansky at the New York Fed put out a paper in June 23. He's called "The Coming Long Run Slowdown in Corporate Profit Growth and Stock Returns." And basically what he said is the boosted profits and valuations from ever declining interest rates and lower corporate tax rates is unlikely to continue, indicating significantly lower profit growth and stock returns in the future. Because he basically attributes the bulk of stock market gains from 1989 to 2019 basically came from the increase in PE ratios coming from the lower risk-free rate and higher corporate profits coming from lower interest rates paid by corporations from the drop in rates and lower taxes coming on the fiscal side from the Bush tax cuts and the Trump tax cuts. So corporate tax rates, which were 35, 37%, are now say 21%. So a good chunk of the earnings have come from lower rates and lower taxes. That's over. So that's another way of looking at a long cycle, that we're moving into a different world. Now, part of the different world is the Fed balance sheet has moved basically from a QE, and you see the big explosion in 2020 where it basically goes straight up. We're now going to QT, so quantitative easing to quantitative tightening. Is the Fed is now in the process of normalizing its balance sheet, and who knows what they're going to decide what the right number is. My guess is it's not the $8 trillion that it is, because if you look at the beginning of this period from 2004 to 2008, it was under $1 trillion. Then it doubles in a year, and then it doubles again in 5 years. And then 2020 to 2022, it doubles from 4 trillion to 9 trillion. That's now coming in, and that's dropping at the rate of, call it $90 billion a month. That balance sheet is now shrinking. Along with this is we have had a normalization of rates, and you take a look at the big spike in the federal funds rate, which is the red line there, and then you have the blue line is the 10-year yield. The 10-year yield went from 5% in 2007 down to basically 0.5% at the low in 2021. And that was sort of the rock bottom low. The 10-year now has been rallying very strongly. It peaked around 5, and now this morning's around 4.12, 4.15, something like that. And the market right now wants to price in about 3 or 4 rate cuts over the next year. My sense is the market's way over its skis, but we'll find out. So that's the thing is it isn't clear to me that we're going back to, I think we're going back to zero. The Fed says the long run Fed funds rate is supposed to be between 2.5 and 3. That's what the Fed governors say right now. So that basically just takes you back to the 2018, 2019 peak for Fed funds, a far cry from zero. The other thing is obviously as inflation is cooling, it's my sense it'll stay above the Fed's target. The red line is headline inflation. The blue line, the red line is headline inflation. The blue line is ex-food and energy. Inflation is coming down. It's probably going to come down, Mike, to 2.5. I don't think it'll get to 2. I also think the Fed will declare a victory at 2.5 and call it a day. And then given the stresses I talked about the economy, it's going to start going back up from there. So that's a big call. All right. The other thing is the S&P 500 is struggling to get back to where it was in 2022. The market's been pretty strong of late. And so the question is this is just a temporary consolidation on the way to much significantly new highs, or this is a top where the market's going to be so roughly stagnant for several years? I'm inclined to think stagnant, sideways more than a big rally. So I think if you want to think of the stock market next 3 to 5 years, I think you do better to think sideways rather than a lot higher. I don't think you have to think a lot lower either. And there's been times in history where the market's gone sideways for many years. And that's sort of my guess. Another point is the S&P 500 has been really misleading because 7 stocks now account for 29% of the index. And that's called the Magnificent Seven after the 1960 Yul Brynner movie, consisting of Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. And if you see the S&P on its own, which is sort of the light blue line, since the beginning of 2020 has doubled, but the market X, those stocks is only up about 30%. So it's really been 7 stocks have been leading the market. And you could also argue is that the S&P 500 is not a diversified portfolio, given that 7 stocks account for 29% of the value of the index. So a lot will have to do with it is the continued strength of those stocks. So if those stocks tend to weaken, the rest of the market could rally. So the market could go sideways with a weakening in those 7, and the rest of the market could begin to catch up. There were some signs of that in the end of November, beginning of this month, but it's still way too early to tell. And in terms of history, the market is expensive on the basis of price earnings ratios. 20 times this year's 19 and 18. If we were in a 0 rate environment, I'd be very comfortable. But if we were to say, call it a 4% 10-year environment, this is historically would be viewed as a high price earnings ratio. So sort of an argument that the market doesn't have much room to go on the upside. So to conclude is, I think we're entering a new 13-year cycle. I think the new cycle will be accompanied by higher inflation than what we've been used to, and higher interest rates. And sooner or later, there's going to have to be higher taxes on both individuals and businesses because the current debt situation is not sustainable. Interest on the debt will be greater than the defense budget next year. Over the long term, expect lower returns from stocks. Over the near term, expect a sideways market with more than the usual volatility. My guess is we'll have rate cuts sometime from the spring, sometime to early summer, we'll have some rate cuts. And who knows what 2020, given the volatile political environment, who knows what election year dynamics will affect the stock market. And one thing is the employment report is coming out on Friday. The most important number is the unemployment rate. The unemployment rate has a 4 in front of it. The market will cheer, thinking that the Fed will ease quicker. If the unemployment rate drops, the market's not going to be too happy. So it'll be bad news will be good news, and good news will be bad news for the market. So thank you so much.
Thank you, David. And your aqua. So, one of the things that David did was look back at history. And here at the forecast, we want to do that, look back at history, look at data, and kind of move beyond the rhetoric. And so I want to show you some data. I'm going to go a little bit quickly so we can get on fire alarm adjusted time. But I entitled this 1995 Deja Vu All Over Again. Folks are starting to talk about maybe a soft landing. And if you've been coming to these forecast events, you recall that we've been talking about that for some time. But 1995 is a time when we had increases in interest rates, particularly the Federal Reserve. And if you look on the left-hand side here, that red line in the circle, you see the increase in interest rates. That was the 1994 start of an increase in interest rates. The blue line is the yield curve, and it doesn't invert, but it's kind of flat. And so that's sort of similar today, but we didn't have a recession then. We did have financial stress. Look on the right-hand side, the infamous Orange County bankruptcy related in part, not entirely, but in part to the increasing interest rate environment. So there's some similarities today, but of course, 1995, as David was pointing out, very different economy from today. We're just starting to engage China in trade. China had only recently joined the WTO. If you recall, those of you who were in the labor force then, we had big desktop computers with floppy drives, and you can kind of go down the list. A lot of things were different about our economy then, but it is instructive that these increases in interest rates don't have to lead to a recession. So what we're going to do is the macro outlook, and then we're going to look at various sectors in the economy, interest-sensitive sectors that increases in interest rates are supposed to affect, and then some other sectors, and that will give you the basis for the forecast that I'm going to show you in the macro section. And then I'm going to do the California outlook after that. So just jumping in, this is our GDP growth forecast. So this is the quarterly, seasonally adjusted annual rates of change. And last quarter, we had a 5.1%, an astonishing 5.1% growth in GDP. Our previous forecast, we were at 2.7. We were, we missed this, but everyone missed this. And what we think is that in reaction to that, we're going to have a slower fourth quarter. And so we have that at 1.7. It was at 2.0. But the numbers we're seeing in consumption, I'm going to talk about that a little bit later, suggest we might be too low. And then we go to 2%. And then the interest rate effects are not driving a recession, but they are driving slower growth in 2024 as the economy adjusts. And then we come back to trends in 2025. And another way of looking at this is through levels of GDP. The blues are actuals. The red dashed line is the 2018-2019 trend of 2.4%. You notice that dashed line is below 2018 and 2019, reflecting all of the retirements of boomers, the millions of boomers who retired in 2020 and 2021. So potential GDP is a bit lower. And as you go to the right of that dip in the 2020 recession, you see that we're at or above potential GDP. And our forecast is for us to stay there for a couple of quarters. And as 2024 unfolds with a slower economic growth, we'll dip below and then we start coming back. But as David pointed out, we're at a 3.9% unemployment rate. And it really will matter what happens on Friday. If this is 3.9 or 3.8 or 3.7, that suggests that the Fed is not going to move as soon as many people expect, certainly as soon as the markets expect, something to keep our eye on. And this is inflation. David showed you this chart. And these are quarterly averages. And if you look to the right of the forecast, it has October year over year for core inflation, 4.0%. So core takes out the volatile energy and food sectors. And the black line turning to red line is headline inflation at 3.2%. But this is coming down. Last month, using month over month, headline inflation was 0. But what we have, and this is, David alluded to this, is even at the end of our near-term forecast, inflation rates are still in the upper 2s. And the reason why these inflation rates are in the upper 2s has to do with the way in which this number is calculated. So the way in which we get the CPI and the personal consumption expenditure index, our two main price indexes, is a survey is done of households, and we get the household budget. And then the Bureau of Labor Statistics goes out and says, well, what are the prices of those items each month? And then they weight those items by their importance in the average US household budget. And so I want to show you that breakdown and what's driving the numbers and why we think the Fed is going to, as David said, declare victory and not keep pursuing a 2% inflation rate. And so you see that in this chart. What you might not, it's a little busy chart, but this breaks down that household budget. If you go all the way over on the left-hand side, what you see is used cars. And the orange is the contribution of used cars to the inflation rate. So it's the change in prices weighted by the percentage of our budgets that go for used cars. And that's negative. And you move to the next one, you've got red and blue, orange and blue there, and that's medical services. And the orange, a little bit smaller, but it was a negative, a decline in prices for medical services. And that added to the blue gives you the cumulative of those two items. And so as you keep going to the right, you accumulate the impact of increases in prices. And you notice that as you get all the way over to the right, before the last two, the rate of inflation, as the impact of price increases in the metric, the way we measure inflation, it is minimal. There are only two things that are driving this inflation rate of 4.0% year over year. The first is other transportation, and that is almost all in repair of automobiles and the insurance to cover them. And that's because the autos that we're driving today are really different from the autos we used to drive, as different as iPhone 15s are from flip phones, right? We have electric cars, much more expensive to repair. We have driver assist, all of these sensors, all of these computers, much more expensive to repair. And so you expect prices to increase. And as our older automobiles are replaced, the mix of cars changes, and that pushes up the average price to repair. So that's not something that interest rates are going to affect. And then the last one there, the big one, is shelter. And shelter is the average rents that people who are renting their homes pay. And much of that is on long-term contracts or rent stabilization units. And as those are freed up, those rents go up to the current rent. And so that builds in some real stickiness in this, not something that higher interest rates are going to affect. It's going to take time for that to work through the system. As that works through the system, as David was suggesting, things like the demand for additional defense goods, the demand for infrastructure for climate change mitigation are all going to add to future inflation, but that's beyond our forecast horizon. So we think the Fed is actually done, and our forecast is for the Fed to keep the federal funds rate where it is going out until you get to late 2024, when the Fed, looking at a weak economy, the weak economy that we showed you in that first slide, says we need to indicate that we are willing to move. And then they start moving, and we have in our forecast 2 decreases in the Fed's funds rate. The economy recovers in 2025 back to sort of trend, and what you get here is the Fed stops at about 4.8%. So keeping interest rate higher for longer. Chairman Powell has said repeatedly they're going to do that, and the markets don't believe him, but he keeps saying it, and that's in our forecast. Oh, that's the wrong direction. So let's look at the interest-sensitive sectors, and why do we get this forecast of no recession, a kind of 1995 slowing of growth, but no recession, because the Fed has increased interest rates, and they've increased them faster than any time since the Volcker shock. And first, we look at housing, and with housing, what you see here is something I labeled a pandemic surge. During the pandemic, what happened with housing is we had a lot of migration, which increased the demand in the South and Southwest for housing. And because we were doing more work from home, we were demanding larger housing units. And that created a surge in building. That seems to be over with. So let's compare before pandemic to after pandemic. And before pandemic, the average 30-year fixed conforming mortgage rate was 4.1%. And we were building about 1.3 million new homes per year. And that's below our historical average. And indeed, we have been since 2006 under building homes. And now if you go forward to today, we've got an average mortgage rate of 7.6%, but look at where the building is. is now up at 1.5 million above historical average. And there are two things going on here. One is that individuals who had mortgages refinanced at low mortgage rates, and they're not selling their homes. Even if they want to upsize or downsize, they're not selling their homes to go from a 2.5% mortgage rate to a 7.6% mortgage rate. And that's pushing people into the new home market. And the second is we have a lot of pent-up demand for housing, and people have jobs, they have money, and so they are out purchasing these newly built homes. And so we have an increase in home building with an increase in interest rates rather than the opposite. And our colleague Ed Leamer wrote a paper a number of years ago that was titled "Housing is the Business Cycle." And that's because most of the recessions that we've seen post-World War II, through these 13-year cycles that David was talking about, were started by housing turning down, home construction turning down. The exceptions are the end of wars, and one exception, the dot-com bust. Right? And we don't have housing turning down. In fact, all of the data and the latest data on construction that came out this week says that it's up again last month. Okay, so we have a positive trend there. This is 1994 to 1996. We also didn't have any significant downturn in housing. We got a dip there, but then it comes right back up. Okay, let's turn to autos, also interest-sensitive sector. And so we're going along at about average. And then we get a dip here. This starts in 2018. We get a dip here when we couldn't go out to auto showrooms to buy cars because of the lockdown. It comes back almost to average, and then we've got a chip shortage. So we're underbuilding autos. We get to today, that vertical line, which is separates actual from forecast. We've got a downturn, slight downturn due to the UAW strike, and then we come back to average. And we may be underestimating what's going to happen here because the US fleet of automobiles is aging. And so we have autos that need replacement. And we also have high gasoline prices and an inducement to go into more energy efficient cars. But we're just holding it basically average here. So another interest sensitive sector that's not imploding, and that was the same thing that we saw in the 1994 to 1996 timeframe. And then durable goods, another interest sensitive sector. Move your eyes from left to right. And what you see on the right-hand side is we're at a record amount of durable goods. And it's kind of flattened out. It's, the growth has slowed, but backlog has actually increased. And so in manufacturing, we don't see interest having an effect except for slowing the growth. Now, this is ex transportation, and that's because of the fluctuations in Boeing orders. So Boeing went 2 months with almost no orders, and then Dubai Air Show, $53 billion of orders. So that just makes the data noisier. But if you add that in and kind of smooth it out, you get exactly the same result. And then finally, on interest-sensitive sectors, any worry about manufacturing? Well, factory construction has soared. And this is because we have new industrial policy that David was talking about. And so we have onshoring and we have new factories because of the CHIPS Act and the Inflation Reduction Act. And so in manufacturing, we're expecting growth, not a decline. So all of the sectors that should be driving us into a recession, if higher interest rates are going to cause a recession, are doing just the opposite. And that's why we have no recession in our forecast. Let's look at some other sectors. And I want to look at consumption and defense and tech. So this is consumption. Consumption remains strong. And here's the trend line. We're above trend, and we're moving away from trend. And this doesn't include Black Friday and Cyber Monday. And those were blowout numbers. Black Friday, the estimates now are 7.5% growth, and that's goods purchases. And if you look back at the CPI, where all of the orange was, the negatives, so goods prices are going down, which means that the real consumption is higher than 7.5%. It's probably more like 9%. We had a good October, looks like a good November in consumption. Consumption is 2/3 of GDP. This is one reason why our forecast may be too pessimistic. So that is consumption. Let's move to defense. Defense is not interest sensitive. It is sensitive to what's happening in the world. And what's happening in the world is it's a much more dangerous world. So even though we have gridlock in Washington, it's hard to imagine we're not going to get a defense bill that increases the purchase of defense durable goods. Our allies in Europe and Asia also see a more dangerous world, and they are ordering more defense durable goods, and about 40% of their orders come to the US. So here's additional demand on top of that consumption that's pushing GDP. That's going to sort of manifest itself really the latter part of 2024 and into 2025, simply because it takes time to ramp up the manufacturing of these goods. Tech, we've heard about the tech layoffs. This is tech employment. These are the subsectors of information and professional scientific and technical services that are kind of specifically tech. Squint as you might, you can't find the layoffs. What's happening here is the large mature tech firms are restructuring, as firms do when they become mature, and they're laying off workers, but tech is expanding and the smaller firms are soaking up those workers. And so that we get growth, slowing growth, as you see here, the slope is flattening, slowing growth, but we get growth. And as soon as that kind of process is over with, growth in tech is going to begin to increase. And you'll see this in California. But in the last quarter, tech employment increased 2% on a seasonally adjusted annual rate. So tech is also growing. So for the US, we've got employment and income remains strong. Interest rate rises, they undoubtedly have cooled the economy, which is why we have slow growth in the coming year. But in housing and in auto, that impact is relatively mild, simply because we haven't built enough of it, right? And usually when you get a big impact, we really have built enough or close to that, or maybe more than enough, as has happened in the bust of the housing bubble. Infrastructure and defense are going to be adding demand to the economy later in our forecast, but they will add demand to the economy and increase growth, but also hold inflation rates high. We've heard lots of predictions of recessions, so I would be remiss if I didn't tell you about a recession. It's coming eventually, but not in the near term. Okay, also I'd be remiss if we didn't talk about the risk, because it is a forecast that has kind of a wider band to it, because there's more uncertainty and certainly conflict in the Middle East and Ukraine. Those seem to be contained, but maybe they don't stay contained. You know, if you read recently the attack on US ships by the Houthis in Yemen, maybe they don't stay contained. That's a risk we need to keep our eye on. And China, Taiwan, India, Pakistan, and you know, you could have a whole menu list of potential hotspots in the world today. Also, as we get into 2024, we have a Republican Party and a Democratic Party with widely different economic policies. And the more uncertain we are about who's going to control Congress, who's going to control the White House, the less likely we are to invest. And so that's something to keep our eye on, how the election plays out in terms of firm behavior in the economy. And then finally, supply chain interruption. So we don't expect this to happen in our forecast through 2025, but storm surge and sea level rise, not going to have much of an impact in the US, can have a huge impact in the manufacturing centers in Asia, in the low-lying areas in Shanghai, in the Pearl River Delta, in Ho Chi Minh City, in Bangkok, and those could really interrupt supply chains. So these are things to keep our eye on. And so now we'll turn to California and the California outlook. And the way in which we do the California forecast is we say, well, California is a huge part of the US. So the forecast should be the same, except for those specific things that are different about California. So we've tried to think about what is different about California. And of course, one thing is we lean to the left. And I just love this picture. But There are other things that are different that actually affect the forecast. This house does not affect our forecast, but it's a cool picture. Non-farm payroll jobs in California dropped by 16% in October, 2.7% above peak. This is why your traffic this morning was horrible. We have peak employment, payroll employment, in spite of, all those people leaving California. You would have expected a better commute to campus. Not so, because they're still on the road here. But where are the jobs in the last 3 months? So over on the right-hand side, we have two sectors: professional, scientific, and technical services. And this is mostly outside of tech. This is accounting, legal services, architecture. I'm going to show you tech in a minute, but tech is not contributing positive growth here. And information's Hollywood. The two strikes are over with. Hollywood's coming back. We expect that to not be a drag on the economy going forward. But if you look on the left-hand side, all of these ones with arrows, so we're skipping construction here, are sectors that are low average income service sectors. Those are catching up from what happened during the pandemic, and those typically don't lead to a lot of economic growth. So this picture of what was happening in labor markets in California in the last 3 months suggests that we're going to have very slow growth in California going forward. And we see that again when we look regionally. The shaded area here is the US, that light colored area. And then if you look to the left of that, parts of California growing faster than the US. And we've got Central Coast, Sacramento and the Delta, and Orange County. And Central Coast and Sacramento and the Delta, some of that is due to the fact that hybrid work allows people to live further afield. And then you go to the right in East Bay, Inland Empire, Los Angeles, even San Diego, sort of close to the US. And usually all of these are way over to the left and faster than the US. And the ones that are furthest to the left are the Bay Area, and now they're the furthest to the right. So the Bay Area has slowed down dramatically. And we're going to see that when we look at tech employment. So again, if we look regionally, we don't have much that tells us California is going to grow as it normally does, faster than the US, maybe about the same as the US, maybe a little slower in this slower economy in 2024. Looking at manufacturing, we're seeing some of the churn in manufacturing. On the right-hand side is transportation equipment. This is aerospace plus Tesla. Towards the left, second from the left, is semiconductors. We have new semiconductor factories being built today in California, and that's going to turn around, but it's not going to turn around till those factories open in 2025. But really what we're losing here are things like furniture. And what we're gaining is high-tech manufacturing. And in the aggregate, manufacturing, durable goods manufacturing jobs have been going up. A lot of that is on the strength of aerospace that is here in Los Angeles County and in Orange County and in San Diego. Our ports, so this is important for logistics. And on the left-hand side is the two large ports that carry about 40% of all goods that come into the US. And the top line is imports. You see the pandemic surge there, right? And that's when we had the gridlock in the ports. And then you move over, it drops down. And a large part of that drop was a threatened strike, rail strike, and the Longshoremen's Union labor action. But now that is coming back, and you see it's back at 2017 levels. We expect that to increase back to about 2018, 2019 levels, in part because those ships that diverted to the East Coast, they're now all jammed up trying to get through the Panama Canal. And the Panama Canal is suffering from climate change and is not able to have the throughput that it once had. But mitigating against that, we have exports. And as bad as people think the US economy is, which it isn't, but people think it is, the world is much worse. And our exports are down. And the latest numbers published yesterday show exports are down again. And until the world economy starts coming back, we're going to see this offsetting some of this growth in our port traffic. On the right-hand side is domestic air cargo. Again, you see the pandemic surge, and now we're back to pre-pandemic levels, but we don't see a lot of growth there, particularly as we actually are starting to shift some of our online shopping, or what would have been online shopping, back to going to retail outlets for experiential shopping. So we have logistics growing very slowly in our forecast. Here's tech. So unlike the US, job growth in tech has slowed in California. The companies that are hiring are picking up the people who are being laid off, so we don't have a decline in tech employment, but we don't have growth. We're not really worried about that, and the reason we're not really worried about that has to do with what's happening with venture capital investment. And so this chart that I just brought up is investment by region of VCs in the third quarter of 2023. And the top, no surprise, the top is San Francisco Bay Area. And then you start going down the list, and you get Boston and New York, and then Los Angeles. And San Diego and Orange County are on here as well. The tech money is coming in here differentially, and that's going to begin to boost the employment once the large tech firms cease their layoffs and that labor supply begins to shrink up. And one of the reasons why this is happening is AI. No one wants to be left behind in developments in AI. And if you don't want to be left behind, there's really only one place you can be, and that's San Francisco. That's the center of AI. So we think tech is actually going to come back. And in our forecast, we have strength in tech, even though this is fairly flat recently. Turning now to housing markets, here what you see in the left-hand side is existing single-family home sales. And if you look kind of left to right, you see three big drops. So we have the Great Recession, we have the lockdown when we couldn't buy houses because we couldn't go out and see them, and we have today. There isn't much in the way of inventory for Californians who want to buy homes to look at and to purchase. And on the right-hand side is the Case-Shiller Home Price Index for San Diego, Los Angeles, and San Francisco relative to 2016. And they're all going up. So home builders looking at this saying, prices are going up, I can get good prices. There isn't any existing inventory, so I can sell what I build, or building more. And where we are today in terms of permits is, so this is the left-hand graph, where we are today is about at kind of the peak that we've had since 2017. So we're poised for growth in residential construction. And we have that residential construction increasing fairly substantially in the forecast because there's a lot of pent-up demand. What kind of homes are being built? On the right-hand side is the ratio of single-family detached homes to multifamily, and it's about 50-50. But one thing that's different here is that because of bills that have come out of the state legislature, we have ADUs being built. So they're smaller units, they cost less to build, they rent for less, and they are, as long as they're not what are called junior ATUs and attached to a home, they're single-family detached homes. So that's part of the single-family detached homes. We also see building in places like San Joaquin County, Sacramento, South Riverside, people who are commuting longer distances, but because of hybrid work, they're able to do that comfortably. And also we see that in the Santa Maria area in Santa Barbara County and north in San Luis Obispo. So that's home building. So that brings us to the end of the California forecast. We have weakness, we have anemic growth, but Hollywood is coming back, so that's the good news. We're going to have tepid growth in logistics, not good news for some of the inland parts of the county, particularly the Inland Empire. Also not good news for at least one sector in Los Angeles. but high-tech manufacturing, defense demand, aerospace, and aerospace is both defense and commercial aerospace, both launch services and commercial aircraft, all are growing. So that's a positive, and that's a real positive for Southern California. Tech AI is the new darling of VCs, real positive for Northern California. And we have construction growing because of the new housing laws superseding local zoning regulations, at least in part, and new building of factories and warehouses in the state. But again, we have risk to the forecast. Housing and homelessness, this is a big issue for where businesses locate. So far, we're not seeing a rush of firms leaving California. In fact, firms are now coming back into San Francisco, but it is a problem and it is a risk to the forecast. Urban public safety as well, and climate change. We have here drought and deluge. We don't know what's going to happen this winter with El Nino or next winter with La Nina. So these are risks to the forecast that we have to keep our eyes on. And of course, all of the national risks that we talked about remain risks for California. Our California forecast, so this is employment growth. In 2019, it was 0.8%, and that was a full employment economy growing with the labor force. And then it drops. And this next year, because of the weak economy, we have 0.3%. And in 2025, we're back to 0.9%. And the unemployment rate is going to go up actually near 5%, and then coming back to about where it was in 2019. So we've got a little bit of hard times, but not recession hard times, just slower growth in the coming year. And then we will, as with the national economy, grow back to trend. And our expectation then is that we, the state of California, will be growing at a slightly faster rate than the US. And that brings me to the end of the US and California. So thank you. Okay, and now what we like to do is turn to our keynotes. And I'd like to introduce Chang Liu. Chang is the president and CEO of Cathay Bank. And he has a 31-year experience in banking. He's a UCLA graduate of Bruin and is on the board of a number of charitable nonprofits. He's on the board of the Federal Home Loan Bank, San Francisco, and also on the board of advisors for the UCLA Anderson Forecast. Please join me in welcoming Chang Liu.
Good morning, everyone. Dr. Nicholsberg is always so kind. I'm not really the keynote speaker. I'm what they call in the music industry. I'm the kind of opening act to the main act. So just give me 5 minutes and I'll kind of give you some updates. One of the things that I want to kind of talk about, one of my 2 affiliations this year that I'm kind of very involved in is the Federal Reserve Bank of San Francisco. I'm on the LA regional board for that, and I've learned a lot through that board. And one of the things that I want to share with you is the November board meeting. The economists from the FRB had several conclusions, and they're very similar to what you guys saw here today. Inflation has moderated, but remains elevated at the same time. Economic activity remains resilient despite higher interest rates. Unemployment is low. You guys will see more numbers on Friday. Labor force participation of the groups under 55 has recovered. That's kind of a key point. Wage growth is slowing. You guys saw some of that on the charts. Data continues to support projected soft landing, although Dr. Nicholsberg thinks there's a recession coming eventually, as you saw that. So the other thing that was also of interest to me was, both Dr. Nicholsberg and Mr. Schulman and Dr. Schulman talked about what they think the forecast is for rate cuts. I think they're saying rate cuts in 2024, maybe 2 of them. There's a thing called Fed Fund futures. I'm sure you guys know about that as well. Fed Fund Futures, as of this morning, is predicting 5 rate cuts in 2024, if you can believe it, which I found astounding. And the first one starting in March, and the first one is projected at 60%, which I think is rather high. The one story I want to share with you guys is through my various boards at FRB, back in January in San Francisco, when I attended the San Francisco board, some of the things that came out of that board was the Fed had pumped in $2.1 trillion into the economy. As of January of 2023, there remains 800 billions in the system left unspent. The projection at the time was that it would be spent down by around September, October. So when I went to the September Federal Reserve Board meeting in Salt Lake, they were projecting that the inflation, they would hit the target 2% by about 2025. Now, what's interesting about that is immediately after in the October meeting, and since then the November meeting, they actually moved that number. They moved now the inflation target of 2% hitting that around 2026. And I asked the question, why? And the answer back to me was BLS thought they had spent down all of the 800 billion, but the reality is there's still 500 billion in the system that needs to be spent down. So because of that, they're projecting that inflation won't hit the 2% until 2026. So take that away for what you think it might be worth to you, and you guys might have your own projections about what the Fed's going to do about the rate cuts. The one thing that Dr. Nicholsberg asked me to talk about today was how regional banks are different. And I could spend 30 minutes talking about Spring. I won't. I'll spend 3. Regional banks are different in the following way. Us at Cathay Bank, we have less than 5% of total assets as our bond portfolio. Bond is not our primary asset class. One of the banks that failed in March had 57% in their bond portfolio. That's a big difference, right? Because when the bond yield starts to go up, that entire portfolio has a valuation issue. We're mark to market. I don't think they were mark to market. Most regional bank CEOs that I speak with, they don't have anything in crypto. They're not a custodian. It's not an asset class. Neither for us. We don't have anything in crypto. And then the other thing, the third thing, sort of distinction I'll talk about is most regional banks, sort of their business and investments are always in the traditional business. And that being commercial real estate, that being residential mortgage, that being C&I loans. C&I is what we call sort of the, you make loans to the manufacturers, distributors, all of that kind of business loans. Those are very basic, traditional kind of business. But one of the distinctions from March and from Spring is one of the banks has a strategy of, if the market mortgage is at 4%, I will charge you 2%. But if I charge you 2%, you're going to bring me everything. You're going to bring me the entire relationship, right? So if that happens, if the way they conducted their business at that 2% number, everything they book onto the system with their mortgage, they're now completely below water. Right, so when there was an issue with the bank and the deposits, and the analysts see what kind of issues they have in terms of the valuation of the mortgage book, that created a big problem for them. So those are some of the differences. And one of the things for regional banks these days is kind of the pressure on the deposit cost that continues to go up. The recent decline in the five-year index, the Treasury bill index, that declined so far by about 40-50 bips. We no longer have the pricing power on the loan side. There's very limited loan activity. There's some, but it's not nearly as strong. So there's continually going to be a margin pressure for the regional banks. But for the most part, I think you'll see regional banks, the numbers are up, both on the loan side and the deposit side. For us specifically, I think by the end of the year, we'll close out our loan growth by about 5 to 6%. Our deposit growth will go up about the same. So we're still very healthy, and I think across the board, regional banks are healthy. At the end of the day, they're there to kind of help their community, help to reinvest into their community. So that's really the key for the regional banks. One of the things that I think made a difference back in March was, until March, most of you probably never heard of Federal Home Loan Bank system. Federal Home Loan Bank was set up about 92 years ago by Congress. And Federal Home Loan Bank is really a way to provide a institution that for the members being financial institutions, credit unions, CDFIs, and even insurance companies, to provide those members with access to liquidity. And they do it by pledging mortgage as collateral. So they encourage the members to make mortgages in their community, in their system. In return, they can have access to liquidity. And the sort of the profit that Federal Home Loan Bank makes, they reinvest into the community for affordable housing. So that's really the mandate for Federal Home Loan Bank system. And so I get the honor of introducing Teresa Bryce Bassmore, who is the president and CEO of Federal Home Loan Bank of San Francisco. She's been there for 3 years and 9 months. I had the pleasure of working with her over this last year, my first time being on the board. And she's got a long bio, so I'm sorry, I got to read this a little bit. So she joined San Francisco as the president and CEO March 15, 2021. She's a seasoned leader with more than 25 years of executive experience building and leading both mortgage insurance and the service businesses. As president of Radiant Guarantee from 2008 until 2017. She oversaw strategic planning, business development, and operations of the mortgage insurance business. Prior to becoming president and serving as Radiant's executive vice president, general counsel, corporate secretary, and chief risk officer. That's a long list. Prior to Radiant, Ms. Bassmore was senior vice president, general counsel, and corporate secretary for Nexstar Financial Corporation and general counsel for the mortgage banking line of business at Bank of America. Ms. Bassmore served on Federal Home Loan Bank Pittsburgh board of directors from 2017 to 2019. Professional appointments she has held include Federal Reserve Bank of Philadelphia Economic Advisory Council, Fannie Mae National Advisory Council, and Consumer Advisory Council of the Federal Reserve. So one more thing I'll say about Teresa. This year, she received the Financial Women of the Year Award from Financial Women of San Francisco. So I hope she's going to be online and she's next due to speak. So I will now turn the floor over to Ms. Bassmore. Thank you so much.
Well, thank you, Chang, and good morning, everyone. I'm delighted to be with you today, even if it's by video. Given that the theme of today's event is to examine the landscape of finance and banking and the implications of recent trends for the economy in 2024, I'd like to review some background and current information on the Federal Home Loan Bank system, which plays, as Chang said, a critical stabilizing role in the nation's financial system, but is not widely known because it most often plays that role from behind the scenes. Can we go to slide 2? For those of you who don't know us, the Federal Home Loan Bank system was created by Congress in 1932 in response to the Great Depression to provide a reliable source of liquidity in all economic cycles. The system consists of 11 regional wholesale banks spread out across the country. Like the other 10 regional FHL banks, FHL Bank San Francisco, which I'm proud to lead, is cooperatively owned. Our more than 300 member financial institutions are both our shareholders and our customers. It's important to note that the existence of the Federal Home Loan Bank system is a major reason why, unlike other countries, the U.S. has a robust financial infrastructure with a vast and diverse array of community, regional, and large lenders that can meet the needs of individuals and businesses, both small and large. In fact, many other countries only have 5 or even fewer banks. Slide 3. And when I think about the founding of the system, I think of the George Bailey character in the classic Christmas movie, It's a Wonderful Life. In the film, George Bailey's institution experienced a bank run, not one that had social media implications or electronic transfers of money, but his customers all wanted to withdraw their funds at the same time. but those deposits have been lent to other customers to purchase their homes. Congress created the Federal Home Loan Bank system to deal with that kind of stress on the financial institutions that existed at that time, which were mostly building and loan and savings and loan organizations, along with insurance companies. If George had had the opportunity to tap loans that we call advances from his regional Federal Home Loan Bank to meet his liquidity needs, it would have helped not just his institution, but the whole community of Bedford Falls. That's exactly what the purpose of the system is. Going to slide 4. It's been an eventful year. So where are we now? Most economists and others now believe that a soft landing for the economy is likely, but challenges and uncertainties still remain. Inflation is slow, but many people are still feeling its effects. The rapid rise in interest rates that began last year has had a significant impact on the housing market. This week, with rates at a peak, the Fed decided to hold on another increase, but they've left their options open, and that will mean what that will mean for the overall economy, and particularly the housing market in the coming year, is uncertain. Slide 5. As our financial system has evolved, Congress has made changes to our membership. Today, our bank's membership, as Chang mentioned, includes community banks, credit unions, insurance companies, commercial banks, and community development financial institutions. And for us, that's across our 3-state district of Arizona, California, and Nevada. Here you can see our top 10 things to know about the system. I'll speak in detail about a few of them. The funding that FHL Bank San Francisco supplies helps our members meet the credit needs of their customers and communities, strengthening the communities they serve, creating opportunity, and we believe changing people's lives for the better. Access to funding is day in and day out from their Federal Home Loan Bank. It gives local lenders the confidence they need to originate mortgages, offer small business and community development loans, and provide financing support for local farming and agribusinesses. The funding we supply to member lenders are collateralized loans, which we call advances. Our bank takes a conservative approach to underwriting. We determine the amount of credit available to a member based on their credit profile. Then any advances must be collateralized with mission-consistent home and small business loans, farming and community development loans, treasury securities, and agency mortgage-backed securities. Those are all designated as appropriate collateral by Congress. In fact, 70% of the collateral pledged to Federal Home Loan Bank San Francisco is mission-consistent mortgage-related collateral. Starting last year, as Fed fund interest rates rose dramatically, several Federal Home Loan Bank member institutions faced liquidity challenges. These lenders had to report losses on investments, even treasury securities, purchased when interest rates were low, because those investments decreased in value in a higher interest rate environment. That includes the many outstanding mortgage loans in this country, the majority of which are at rates of 4% or less. Slide 6. The FHL banks were there to meet the needs of our diverse membership as a result of these interest rate increases. Well-respected economist Mark Zandi of Moody's Analytics, in his November paper entitled "The Federal Home Loan Bank Supports Systemic Stability," specifically cited the critical role that the FHL banks played in keeping the banking system liquid when the consumer confidence plunged after high-profile bank failures. Banks relied on new Federal Home Loan Bank advances to strengthen liquidity and also pre-positioned additional collateral to support future draws if needed. So to put it another way, the Federal Home Loan Bank system was once again a calming force during market volatility, delivering vital liquidity that helped stabilize the U.S. banking sector and with it, the larger economy, just as it did during the Great Financial Crisis or the early days of COVID, when the global economy was immediately gripped by uncertainty and access to liquidity from other sources dried up. Slide 7. After the failures of Signature Bank and Silicon Valley Bank, the Federal Home Loan Bank system experienced increased demand for advances and issued $304 billion in debt through the global capital markets in a single week to provide more liquidity to Federal Home Loan Bank member institutions across the country. The system was designed to work just like this, to expand and contract. You can think of it like an accordion, according to the liquidity needs of our members. Through our system's Office of Finance, we raise funds in the capital markets to lend to our members. Our status as a government-sponsored enterprise allows us to raise capital at favorable rates that benefit our members and the communities they serve. This is especially true for smaller members who do not have their own direct access to the capital markets. We do not receive our funding from the government and so are reliant on running a profitable business. At Federal Home Loan Bank San Francisco, about 50% of our members are borrowing on any given day. In times of stress, of course, we naturally see increases in the number of members that borrow and the amount they borrow. Slide 8. By executing on our foundational mission as a reliable supplier of on-demand funding and risk management tools, we are contributing to the health of regional and local lenders, CDFIs, and insurance companies, and enabling economic resiliency. Slide 9. But ours is also a dual mission, with the second part enabled by that first foundational mission of being a liquidity provider. Slide 10. Because of the business our members do with their Federal Home Loan Bank, we can also partner with them to direct a portion of our annual net profit to addressing a variety of unmet housing and economic development needs in the communities we collectively serve. Together, we are increasing the supply of quality, affordable housing, facilitating equitable and sustainable homeownership, and driving economic vitality, all with the goal of making our communities more vibrant, equitable, and resilient, and changing lives for the better. Slide 11. At FHL Bank San Francisco, we are governed by a board of directors with 8 member directors and 7 independent directors, 2 of which are public interest directors. Also, it is important to note that we are privately capitalized. Members must own stock in order to transact any business with us. They must purchase additional stock when they are actively borrowing from us. Our stock is held at par value and not traded. Depending on the profitability of the individual Federal Home Loan Bank, any return on a member's invested capital is through any quarterly dividends paid. Our board makes a determination on dividends each quarter based on our results from the prior quarter. We also have an active Affordable Housing Advisory Council, which is a 15-member volunteer advisory group made up of senior affordable housing and community development executives who help us shape our grant programs to respond to local needs. Slide 12. By congressional mandate passed in 1989, each Federal Home Loan Bank contributes 10% of annual net profits to our regulated affordable housing program, or AHP. Slide 13. Through the AHP program and our other voluntary programs, we are empowering our members to build or preserve affordable housing, support first-time home buyers, and promote economic development. Slide 14. Through the AHP, the Federal Home Loan Bank system is one of the largest private sources of grants for affordable housing in the country. In total, the 11 federal home loan banks have awarded more than $7.6 billion to create or preserve affordable housing since the first grants were distributed in 1990. This funding empowers Federal Home Loan Bank members to partner with our community developers, affordable housing developers, to help meet the persistent need for more affordable housing for very low, and moderate income families and individuals, including many especially vulnerable populations like seniors and the chronically unhoused. Over the life of the competitive HP in San Francisco, we have awarded $1.14 billion to build or rehab over 141,000 units of housing in Arizona, California, Nevada, and other places where our members do business. HP-funded projects serve families and individuals with incomes up to 80% of area median income. And we are proud of what the HP does because an affordable place to call home is the foundation of a brighter future. It can increase the financial security of a young family just starting out, a senior who wants to age in place, or an individual who needs both shelter and supportive services to start over. This year, Federal Home Loan Bank San Francisco was proud to be the first in the system to implement a state-targeted HP fund to address the critical affordable housing shortage in Nevada. We were excited to announce in July that we awarded $4.8 million in Nevada targeted grants for 6 important affordable housing developments in the state. Slide 15. While expanding affordable rental options is a high priority nationwide, we also know that homeownership is the most impactful tool for wealth building and a key to building strong, stable neighborhoods. Fostering homeownership is core to our mission. We set aside up to 35% of our 10% annual HP contribution to fund our WISH first-time homebuyer matching grants, which flow through our members to home buyers with incomes at 80% or less of area median income. Since 2004, we have dispersed more than $141 million in those WISH down payment assistance grants to help nearly 10,000 families and individuals achieve their dream of owning a home. But that is not all the Federal Home Loan Banks do. In partnership with members and other stakeholders, we also invest in and strengthen communities. At the San Francisco Bank, we undertake an annual process that looks at other unmet housing needs in our district to determine how we can best address them outside the constraints of the highly regulated HP. While all of the Federal Home Loan Banks have funded other voluntary initiatives over the years in excess of the 10%, all of the banks committed earlier this year to increasing that voluntary portion up to 5%, making the contributions to affordable housing and economic development 15% of annual net profits. There is some cost to increase HP to 20%, and while the HP is important and impactful, the banks feel strongly that any additional community support funding should be more flexible and aimed more directly at addressing specific local needs rather than being constrained by national one-size-fits-all requirements. Slide 16. As a result of the increased commitment, in May of this year, we launched a new $10 million pilot program to offer down payment assistance grants for the missing middle. People who are our teachers, firefighters, and other essential hardworking members of our communities with incomes from 80% up to 140% of area median income. These aspiring home buyers are credit eligible to purchase a home, but they haven't been able to save the down payment given the high cost of housing and the competing escalation of rent and other essential expenses that make saving so difficult across our district. Given rising interest rates and an already high-cost region, our membership enthusiastically embraced this opportunity to help their customers and members. By August, the entire $10 million in funding had been committed, and 45 participating members have completed dispersing grants of up to $50,000 each to 216 homebuyers. Slide 17. In 2004, the Federal Home Loan Bank of San Francisco launched our AHEAD Economic Development Grant Program, which facilitates partnerships between our members and the nonprofit organizations, local government agencies, or tribal associations that have real on-the-ground expertise in meeting local needs and creating economic opportunity. With funds allocated by the board annually, the AHEAD program is designed to be flexible and easy for members to use. AHEAD funding supports organizations that are creating or preserving jobs, delivering job training or education programs, supporting small businesses, micro lending, and micro enterprise incubation for low-income entrepreneurs, or addressing the special needs of at-risk youth, veterans, persons with disabilities, the formerly incarcerated, and tribal communities, among others. Demand for AHEAD continues to grow year after year, and recognizing that many of the nonprofits that are in the business of meeting the needs of underserved communities need extra support. This year, our board more than doubled prior year funding to $4 million. With the maximum individual grant amount increased from $25,000 to $100,000 in this funding cycle, 53 of our members sponsored successful applications for the important work of 75 nonprofits that are doing this work to expand opportunity for underserved communities. Slide 18. At FHL Bank San Francisco, we are also committed to advancing racial equity and narrowing the Black homeownership and wealth gaps. The Black-white homeownership gap is wider today at 30 percentage points than in 1960 when housing segregation was still legal. Because knowledge is power when it comes to buying a home or sustaining homeownership, in 2022, we engaged with our members to provide financial resources to HUD-approved housing counseling agencies, or HCAs, that serve communities of color. Slide 19. With a $1 million allocation for our new Empowering Black Homeownership Matching Grant Program, we partnered with 14 of our members to direct more than $2.2 million in new funding to HUD-approved housing counseling agencies. In the pilot program's first year, 22 housing counseling agencies received funding to expand capacity to better serve communities of color. Our board recently approved a $2 million renewal of funding for this very successful pilot program. Slide 20. Also, as part of our larger commitment to working to narrow the homeownership and wealth gaps, we entered into a $1.5 million Racial Equity Accelerator for Homeownership research collaboration with the Urban Institute, which was designed to explore 4 priority areas of mortgage finance that have historically disadvantaged people of color in their pursuit of the many benefits of homeownership. With this evidence-based research initiative, we felt it was critically important to widen the lens to see how systemic and structural barriers to homeownership for people of color might be addressed, and how we can change the rules of the road in mortgage finance. The Racial Equity Accelerator has focused on 4 areas that we identified as ripe for innovations that would help advance equity. First, bringing more information into the underwriting process that will still result in sustainable loans where the borrower has demonstrated the ability to repay. Second, addressing the burden of student loan debt that disproportionately affects people of color given past barriers to wealth building. Third, finding solutions to short-term payment issues to avoid foreclosures. And fourth, addressing racial bias in artificial intelligence. Our Urban Institute collaboration will culminate in February 2024 with an Innovators in Mortgage Finance Symposium being held at UCLA. This will be a showcase event where our members and others will have an opportunity to hear from and vet the most promising innovations that this research has identified for facilitating more equitable homeownership. Slide 21. In 2022 and 23, we also invited members, policymakers, and industry stakeholders to a series of homeownership solutions summits that we held across our district to share ideas, explore best practices, and coordinate public and private collaboration to better address the urgent demand for affordable housing and equitable homeownership opportunity. As a direct outcome of these summits, in October of this year, we published a package of recommendations for updating the housing ecosystem in a report called Closing the Racial Equity Gap, a call to action, which is available on our website. Our efforts to advance racial equity are premised on the idea that innovations in mortgage finance are not just a matter of fairness and opportunity for people of color. Rather, solutions in financial inclusion and racial equity will benefit the housing and mortgage finance industry, opening up opportunities for lenders and others to grow their businesses by serving a much broader demographic, and this will benefit the larger economy. Slide 22. Just about a year ago, the Federal Housing Finance Agency, our regulator, began a comprehensive review of the Federal Home Loan Bank system, calling it FHL Banks at 100, focusing on the future. They held listening sessions and roundtables around the country and solicited written comments from more than 800 stakeholders. Throughout this process, we have been actively engaged in the discussions of how best the mission and role of the Federal Home Loan Banks can be enhanced to meet the always changing needs of our members and communities. Slide 23. Last month, the agency published its Federal Home Loan Banks at 100 report, which represents the beginning of what we anticipate will be a long process aimed at ensuring the Federal Home Loan Banks remain well positioned to serve their members and their members' communities for the next 100 years. We are grateful to the hundreds of stakeholders who participated in the review process over the past year and publicly acknowledge the vital role the Federal Home Loan Banks play in supporting local lenders, local businesses, and the broader financial system. Our members know they can count on us through all market conditions, and the overwhelming sentiment from this review has been that stakeholders want more, not less, from the Federal Home Loan Bank system. Publication of this report is the starting point for debating potential changes to the system through supervisory action, new regulations, or recommended congressional action. We are not opposed to change itself. However, we believe that for any change to be successful, it is critical that the regional nature of the federal home loan banks be maintained to continue to effectively serve a geographically diverse membership. That all current members of the federal home loan banks continue to have equal access to the federal home loan banks. And any changes to membership, structure, or operations are aimed at enhancing the value of the federal home loan banks and helping to maintain the stability of the financial system. We believe it is critical that the process for any proposed change be fully transparent, and we must all guard against negative, unintended, but foreseeable consequences. As that discussion is ongoing, it will be business as usual in terms of serving our membership. So stay tuned for more on what's next for the Federal Home Loan Bank system. And a thank you again for having me join you today.
Thank you, President Bazemore. Are you still on?
I think I am.
Okay, George, can you do the stop share? So do you have a few minutes for questions?
Sure. I think I have a couple minutes.
Okay, so let me start and then we'll take questions from our audience. You spoke about the programs that you and your members have for enhancing the supply of affordable housing in the district. We're in a high interest rate environment. Housing has become less affordable. What challenges has that presented to the Federal Home Loan Bank and to your members?
So that's definitely been an issue in two different ways, I was at a minimum. So one is, as we talk to the members of our Affordable Housing Advisory Council, many of them are affordable housing developers. And what you hear consistently is that the cost of development has continued to rise. And they really haven't seen, I think we all were hoping that as supply chains got better, et cetera, that we would see some of those costs come down, but not as much, I think, as we had hoped we would see. So that's been an issue for sure. There continues to be a newer issue that we were talking about actually just yesterday, which is the availability and cost of insurance, which is another area that I think there's going to have to be quite a bit of focus on. I think we tend to think about that in terms of single family homes and our individual ability to gain access. But what affordable housing developers are saying is for their developments, once they're completed, they're starting to see doubling of insurance, which makes it difficult to have to operate effectively and cost effectively those developments after the fact. So when you think about our AHP program, what we're really doing is giving grants to finish the work that's done. So most of these projects have a number of different sources of funding, and we're kind of the last piece to help make those happen. I mentioned the down payment, middle income down payment assistance program. We did that because from a regulatory point of view, we're required to only use the down payment assistance from our HP program for those who are at 80% of area median income or less. But as you rightfully point out, that is particularly challenging in California. And we see a lot of those dollars disproportionately go to other places outside of California. And so that's why we did the voluntary down payment assistance program at 80 to 140, because given the high cost of housing, that there's a huge need for that in California.
Thank you. And do we have questions from our audience? Yes. And the question, I'm going to repeat the question for our online audience and correct me. if I
Including for
didn't
me. Thank you.
were you able to hear the question okay?
I could not hear the question.
Okay. So the question is, in what way are you and your members, or you through your members, able to support minority-owned institutions and and community development finance?
So with respect to minority financial institutions, those institutions are eligible to be members of the Federal Home Loan Banks. I would say that a lot of our members, including some of our community development financial institution members, also do quite a bit of lending to small businesses. And so in that way, we're able to support through our members, small businesses. Some of those institutions do focus on small businesses and lending to minority-owned businesses. So we do know that is, for us, it's a bit more indirect, but we try to make sure that our members understand that. And in fact, we, over the last 2 years, we've actually sponsored a DEI symposium for our members to help them think about the demographic changes in our district, to think about how to do a better job of reaching out to diverse communities to be customers of their institutions, how to think about utilizing diverse suppliers as part of their institutions, and how to think about making sure that they are having a diverse workforce.
Okay, do we have another question? Yes.
Collapse. Oh, cool. I have Mike. After the SVB collapse, I think the Reserve took steps to increase banks' ability to access capital by allowing them to borrow against the nominal value of their securities. Was that through the FHLB lines, and is that going to be extended?
So
Or
that was
expected to?
Yeah, I did hear that question. So that was actually totally separate. So when you think about the Federal Home Loan Banks, we don't actually access any of our funding from the government or the Federal Reserve. We actually go into the capital markets to raise our funds, which makes us very different in that regard. What you're referring to is the bank facility that the Fed set up actually that Sunday evening. Right after the failures of SVB and Signature, which is a 1-year facility that they set up. I don't know whether there'll be any extension of that, but that's a totally separate facility from the Federal Home Loan Banks.
And I think we have time for one more question if we have another question. Okay, I'd like to do a follow-on question. To what extent do you identify low-income neighborhoods in your programs to enhance financial services there?
So that is something that we work with our members on, but in terms of our liquidity and affordable housing mission, I talked about what we're doing with HUD counseling agencies. And, we've identified HUD counseling agencies that are working in primarily minority communities in trying to help with homeownership and also sustaining homeownership. But if you're referring to sort of the expansion of institutions themselves, that's not something that we would be participating in.
Thank you. I know that you have a busy schedule this afternoon in San Francisco, so we really appreciate you being able to be with us virtually. So please join me in thanking President Bazemore for being here for a very insightful presentation.
Well, thank you for the opportunity to participate. Have a great rest of your conference today.
Thank you. So we are coming up on time for the break, and during the break, we'll have our panelists, and we have an amazing panel today, get mic'd up. We're going to take a 10-minute break. We are just about back on time. We're closing in on leaving fire alarm time to regular time. We had one presentation that you see in your agenda, which is by one of our newest economists, Thomas Ash, on green bonds and financial markets. And because of the fire drill, we're not going to be able to do that today. But Thomas is going to do a video that we'll put up on our website so that you don't have to miss his presentation. Really interesting on how green bonds are interacting with financial markets. So that look for on our website. And let's take a 10-minute break, and we'll be back here at 11:05, and we can get going with this panel. Thank you. Okay, we have a fantastic panel today, and I am going to let our panel moderator introduce the panel. Our panel moderator today is Lori Sentikian, and Lori is an adjunct associate professor in finance and strategy here at the Anderson School, and she's also the faculty director of the Fink Institute for Finance. Prior to joining UCLA, she was a professor over at the Marshall School at USC and earned her PhD at Harvard, has worked in a variety of areas in finance, well-published, and has earned a number of awards for excellence in teaching here at UCLA Anderson. So we are very pleased to be partnering with the Fink Institute for this conference, and very pleased, Lori, that you are moderating our panel, and I will turn it over to you.
Thank you. Thank you so much, Jerry. Welcome, everybody. Welcome to UCLA Anderson. We're really delighted that you could all join us. As Jerry said, the Fink Center is partnering with this event. We look forward every December to partnering with the forecast on thinking about financial markets. So thank you especially to our panel for joining us. I want to give everyone an opportunity to share their expertise and background before we get started. Maybe we could start with David Tuyo, who is president and CEO of University Credit Union.
Yeah, so David Tuyo, president and CEO for University Credit Union, founded here at UCLA, now serve the entire UC system and universities across this great country, and been at University Credit Union now for 7 years, about 25 years in financial services.
Barney Hartman-Glazer. I'm an associate professor here of finance. I've been at UCLA Anderson for about 11 years. Prior to that, I was at the Fuqua School of Business at Duke University, and my research focuses on banking and finance. Pleased to be on.
Good morning. I think it's still morning. Yeah. I'm Anita Robinson, and I'm a retired commercial banker, community banker. I have been involved in a number of startup community banks, community development banking, and turnaround of trouble banks, and I've seen a pretty wide span of years of decades of activity in this banking business. So thank you for the invitation for today.
Hi, I'm Joe Brusuelas. I'm the chief economist at RSM. Prior to that, I was the chief economist at Bloomberg LP. Some of you may have seen me around before here at the Forecast and other places, and we're a sponsor of the Forecast.
So again, thank you to Jerry, thank you to Teresa and Chang for their insights so far. They've given us a lot of food for thought, and now we get to dig even deeper. Even deeper into the banking markets and understand from our diverse array of experts. So let's actually start with some context. In the landscape of traditional banking providers, we have large banks, we have community banks, we have credit unions. Can you help us understand the key differences and key similarities in their business models? Maybe David, you can start, and then Anita, if you could follow.
Tough question. So Structurally, there's different types of financial service charters that are out there and financial service charters rather. And credit unions are not-for-profit financial cooperatives that traditionally focus in on a particular set of employer groups that happened over time. And then in 1998, Congress passed a bill called HR 1151 that opened membership access to essentially everyone in the United States. And since then, consumer-driven financial institutions that are member-owned and have a volunteer board of directors and continue to be not-for-profit and serve member owners. So there's no stockholders, there's no conflict from a stakeholder perspective. 100% of the profits get returned back to the member owners that have accounts at the cooperative or at the credit union. So a very interesting structure, very different than you might see in other areas, typically smaller in nature. So you look at credit unions as a whole in the United States, about 9% market share, so very small relative to the large banks. As an entire industry, our industry has about just under $2 trillion in assets. So we'd be, as a combined industry, approximately the fourth or fifth largest bank in the United States.
Okay. Cool. Anita, could you tell us a little bit about regional banks and community banks and how they differ?
Yes, well, actually, you know, they've evolved over time, certainly. At one point, a small community bank might be under $2 billion, certainly under, you know, $1 billion. And today, I think the threshold is closer to 10 billion, looking at what is kind of the threshold known as a regional bank. Community banks are typically, you know, they're capitalized within their community, they're serve their local community. What you see is still a large percentage of those community banks in the Midwest region because they can maintain a unit bank and also they have smaller communities or towns or areas that they're serving. And then you make the steps up beyond that into the regional banks, multi-regional, where they have, you know, throughout different regions, and of course into the national and the very large banks.
So just continuing with context development, only a few months ago, we were in the midst of a banking crisis that involved several bank failures, most famously Silicon Valley Bank. What, Barney and Joe, if you could help us out, what context is important to keep in mind as we navigate the aftermath of that? And what are the key takeaways for the root causes of those failures?
All right, so I think the main thing to the theme we want to pick up on is the one that was introduced at the very outset. We're not going back to zero interest rates.
Yeah.
The term maturity spectrum is shifted up and to the left, you'd say in academia, or in plain English, the cost of borrowing money and financing everything is just going to be more expensive on an ongoing basis. All right, I'm an economist, so I start with where the neutral rate is. We think it's around 3%. You think the economy is going to grow at 2%? Inflation is at around 2.5%. That means long-term is going to be around 4.5%, probably with upside risk towards 5%. Right, so we're in a very different situation now. Why did we have the mini crisis? From my point of view, it's because lax risk management on the part of local and regional banks. Now, if you talk to a local and regional banker, they're going to blame the Fed, right? Because the Fed got behind the curve. The inflation genie got out of the bottle. And there's a lot of reasons why inflation spiked and why it remains persistent. That's a different debate and a different discussion for a different day. Nevertheless, what it means is that the 4,100 or so local and regional banks going forward, despite the liquidity enhancing program at the Fed to help out during periods of stress and tensions, my guess is we're going to see a consolidation in that area. Now, my firm serves businesses that typically have between 10 million and 2 billion in revenues. We call it the middle market. I prefer to talk about it as the real economy. My firms, my clients, they bank with those local and those regional banks. So I'm not putting that out there to be provocative. It's in my company's interest for us to have a vibrant, dynamic, small, local, and regional bank and system that serves it. But my sense is we're pivoting to a new era that will likely see a consolidation. And I hope we get a chance to talk about what that looks like here on this panel.
Barney, could you elaborate?
Yeah, I want to pick up a bit on what Joe said in terms of risk management. And SVB and Signature and to a certain extent, First Republic are kind of like the headline cases of losses on what we call hold to maturity securities. And these are treasury securities held by banks with the intent to hold them until they fully pay off. And you know, the big problem that these banks faced was they loaded up on these treasury securities and they rapidly lost value when the Fed raised interest rates. Interest rates go up, bond values go down. But it's not, this problem is not necessarily unique to those headline cases. So if we aggregate all of the hold to maturity securities across the banking system, and we look at the losses during this rate hiking cycle on those hold to maturity securities, we're talking about around $2.2 trillion. And so that's certainly not localized to Silicon Valley Bank, First Republic Bank. Now, in the past, losses like these have been absorbed by the other side of the balance sheet, deposit franchise. So hold to maturity asset values go down, but the value of creating deposits goes up. And my concern for the banking system going forward is that those deposit franchise values are no longer as stable as we thought they were because of advances in technology in terms of the velocity of deposits moving around the banking system or moving in and out of the banking system. That the risk management part, the hedge where deposits hedged hold to maturity securities is less strong than it used to be, potentially very fragile.
Can
So-
I add to that?
Please do.
I'm going to pull the curtain back a little bit
Yes.
further on this.
Very much so.
So mechanically, how does that happen? Well, we talked about the influx of cash, the injection of cash into the economy. And that went into the banking system. And so what you saw is in the banks, their deposits jumped up substantially during that time period. They're required to either get that money out, invested in loans, which is, you know, the optimum, or they have to invest in their securities portfolio. Banks are very limited as to what they can invest in their investment portfolio. And when they put them into a hold to maturity, and then they are required to mark to market, that is not necessarily a loss, it's a paper loss, in as much as it only becomes a real loss when they actually have to sell those securities for liquidity purposes. And so when you saw the run on the bank and you saw the decline in the deposits go very rapidly within those banks, they then had to trigger a real sale. And that then created real losses. In the meantime, when they are marked to market, it is a capital effect. And so when they have a negative capital effect, there is a requirement, minimum requirement of capital within the bank. The regulators then enforce that need for more capital, and you're going into a market where it's not readily available.
It's important to note, though, especially in the case of Silicon Valley, they had an effective hedge on through October 2022. They chose to jettison that. That was a function of a management decision. Moreover, when we talk about balance sheet, yes, you've got unrealized losses, but you also have unrealized gains on the other side, right? One of the most popular games on Wall Street is to talk about the large unrealized losses at Bank of America, which always makes me chuckle because you never hear the same fellows talk about the unrealized gains, which is why this works. And I think that we have to approach this, and yes, there's going to need to be some re-regulation of the business. There has to be a more flexible framework on how risk is managed. We simply can't go on like this. But that's part of what I hope is going to be a national conversation on whether we're going to keep a very different banking system than we see with our primary trading partners, say over in the UK and Europe, right? Where they just don't have a dynamic and vibrant, small, local, and regional banking system.
I think it's important also to note that the data that's provided so far was only exclusively about banks and not about credit unions. There's over 4,600 different credit unions in the United States that are federally insured today. And at no time has there ever been a loss to a depositor ever in the history of the credit union movement in the United States that is federally insured. So It's the only charter that can say that. So again, some of the data points are outside that of credit unions, which is a significant part of consumer finance in the United States.
So all this turmoil happened in the spring, and there was a lot of fear that the contagion would spread to more banks and there would be more kind of broader failures. That sort of widespread contagion didn't take place, but regional banks are still, in some sense, in an existential crisis and suffering. So if we look at predictions for profitability, there's a sharp decline. What's going wrong? What are some of those headwinds? Especially, if we think about rising interest rates, that's typically a benefit for regional banks, but the opposite has happened. So what's been going on? How do we make sense of that? Anyone?
Well, maybe I could chime in on why rising interest rates can be a benefit for banks and why maybe this time might be a little bit different. I'd like to hear from my practitioner colleagues on the panel if they disagree with this. But fundamentally, if you can think about the business of banking, of issuing deposits at essentially below the policy rate, so you're paying lower interest on deposits and then reinvesting that money in either productive loans or in treasury securities to earn some kind of net interest margin. And as interest rates go up, the interest that you charge on new loans or the yield that you can get in newly bought treasury securities increases, but you don't have to pass that through one-to-one to depositors because you're providing them valuable banking services, right? That's why depositors are willing to park their money at below market interest rates. And a key thing here is that the pass-through to deposits doesn't necessarily have to be the same as the pass-through to loans. And that's historically been the case. So if you just look at the history of banking, maybe let's take the savings and loan crisis out. The sensitivity of deposit rates to interest rates is around 0.6. So interest rates go up by 1%, deposit rates go up by 60 basis points. But getting back to something I said earlier, which is that my concern about something I've called the velocity of deposits increasing is that as consumers, households and firms are able to move deposit institutions more rapidly, that pass-through is going to have to increase. And that's fundamentally going to put pressure on banks' margins. We heard that already today, but it could also have some implications for bank stability. So typically when we were in a rate hiking cycle, maybe that meant that you got to earn a larger term spread. But I don't know to the extent that that's going to persist.
So in one part, it's the shock of one era ending and the new era beginning. In the third quarter of this year, we did a special survey, what we call the Middle Market Finance Survey. And what we found was really interesting is that not only are you seeing a diminishing of risk appetite among borrowers and lenders, right? But if you need to hit a bank for a C&I loan that Chang was speaking of earlier, right? SOFR, System Overnight Finance Rate, that's the benchmark, sitting at 5.31 right now. Our survey told us that the average risk premium was 800 basis points. That means you're paying between 12 and 15%, depending on the health of your balance sheet, right? Let me provide a useful contrast. I was, in Vegas a couple of weeks ago, the circus came to town. We had the Formula One race. Some of you might have noticed that in the media. A Liberty Media that owns Formula One wanted to reprice some debt that it had, needed to reprice 1.7 billion worth of debt. They went to market, they paid SOFR plus 200 basis points. I don't know about you guys, but most of the firms that deal with credit unions, local or regional banks, are credit-worthy institutions that are going concerns. I don't think that 800 basis point risk premium is something that can last. Moreover, what we found is that 36% of our respondents who needed to access financing for payroll and expansion were hitting the shadow market, right? So you're starting to hear not just about private equity, but private credit, and I hope we get a chance to jump into that later, because that's a whole new area in the shadow market. That's now a $2 trillion business, right? So it's the structural shift along with higher interest rates as the Fed tries to restore price stability that I think is really what's causing the Fed ended the crisis for all intents and purposes, but we've just been floating sideways for the last several months. And it's this inability to understand that at one point, real rates, which of course as inflation comes down, they rise, has to be stabilized and then brought back down before we're going to see a reignition of risk appetite, not just amongst borrowers, but amongst lenders.
And the betas that were mentioned earlier, it depends on the type of account, right? So you look at your checking account, for instance, we pay up to 5% of checking account, that hasn't changed. But you look at CD portfolio, all of a sudden that's changed dramatically. Whereas prior to the pandemic, you saw interest rates that were near zero, you saw CDs that might have been 0.5% or 1%. Now there's a 6% CD out there, right? So as federally insured money, it's higher than Treasury. So it's very interesting to see how it happens. But again, we're seeing slower deposit growth because the national savings rate is actually at Great Recession levels. And we're seeing credit card debt on the consumer side that is through the roof. And so we see spending, we saw these great graphs about how things continue to increase and the consumers is very healthy in their spend through Black Friday and Cyber Monday. But when we look at the actual data about where that money's coming from, our credit card portfolio at University Credit Union has seen an increase of 89% in credit card balances from pre-pandemic levels. And on a per person average basis, a 59% increase in credit card balances since then. And so financing all these purchases and this new change of behavior with debt. And that is a great concern for us. And so we want to make sure that we have responsible consumer finance and we'll continue to provide education for the consumer so we don't get back into the same case of what many are forecasting as being another HELOC ATM situation in 2024. And so these are things that we're concerned about and continue to watch.
That's a great phrase, HELOC ATM. So you mentioned the rates that you're having to pay on deposits and competition for deposits has really intensified. How is this arms race for deposits playing out? What are you hearing from clients? What is on your clients' minds?
Can I give you, I did a little bit of research before today, and over the past 20 years, we have seen, and now I'm just talking about the commercial banking sector, but we have seen a decline from over 9,000 banks nationwide to about, I think it's down to about 4,200 now. And in those banks, we have seen a growth in total assets from 9 trillion to 23 trillion dollars. So you have fewer banks holding more in assets. And on the deposit side, over the past 20 years, banks held $5 trillion in deposits and now hold 17 trillion in deposits. So you have more cash on deposit with those banks. So as we talk a lot about what's going wrong with the banking system, the risk models are different for every type of bank. And of course, there's there's high scrutiny on the risk of every bank, believe it or not. We don't hear about it all the time, but they're all running different risk models, interest rate sensitivity, deposit sensitivity. And so you look at the depositors that have $250,000 or less on deposit, they're fully insured. Their deposits are fully insured and generally are not at risk. And, historically that's proven to be true. Anything over that, of course, technically is at risk, but in practice hasn't really had the risk that we associate with. So now when you look at the number of problem banks on a nationwide basis, in 20 years ago, there were 116 problem banks, and today there's 44 across the country in those 4,000 banks that we're talking about. Failures, we've had 4 failures. Now, in the height, we had almost 300 between 2009 and 2010. So, and the reasons are all very different. The question about, what's happening to the earnings in banks, why are they less profitable? Well, basically, the fundamental rule is you manage that interest margin or the spread, right? So historically, the deposits, so you put your money in a bank and you earn, 50 basis points on it, let's say. Those are data facts. 50 basis points on it. And then you'll watch the interest rates rise. Well, you don't see that interest rate rise immediately with those interest rates. However, if you're borrowing money and you're at a variable rate, you'll see that the interest rate on the loan side go up immediately. And so that's where the banks historically have had the benefit of making money during a rising interest rate environment on the margin that they're seeing between the deposits and the loans. So what's changed? Well, you have a larger or a more significant demand for fixed rate loans. So if they fix the rates and they're longer term, then they have interest rate risk in a rising rate environment because those rates are going to go up on the bottom end, but they're fixed on the top end. And they can hedge and they can, there's a lot of different tools out there for them, but generally that'll squeeze that margin. I'd say one of the biggest factors is the cost of doing business. And with the cost of the regulatory environment, two things happen. One is it pinches those earnings on the bank, ability to earn money in that spread. Their cost of doing business has gone up significantly. And the other thing is that what we begin to see is a move to fee income to supplement their interest income. And with that comes new line of products and their earnings model looks different now than it did 20 years ago. So, that's really, I think, a lot to do with it. The cost of doing business is significantly more, which is why you're not seeing de novo banks coming out. The cost of capital is much higher. All of these factors are creating barriers to the de novo bank wanting to start up. It's cost prohibitive.
That's right. And actually, the converse of that, we're starting to see more consolidation, right? And Joe mentioned that as well. You mentioned also competition for deposits are scarce. They're more scarce now. That's expected to contribute to a lending slowdown. If that gets coupled with any sort of signs of an economic downturn or trouble in the commercial real estate market, that could exacerbate problems even more. And then all of this is sort of raising the possibility of deeper consolidation. How should we think about consolidation? What do you think is more likely to happen? Help us sort of think about these things. Joe, if you wanted to pick up where you were itching to talk more about consolidation.
Yeah,
so
when we had the crisis, and some of us went down to the New York Fed and, we were sitting around the table and we wanted to know, okay, this clearly is just the tip of the iceberg, right? They only thought at the time there was another 25 to 30 banks that were going to need some policy attention. So the idea of 40 or around 40, that makes a lot of sense to me. It's large compared to the number, I guess, but not anywhere near what we saw during the savings and loan crisis, which hit here in Southern California, and then of course the great financial crisis, right? But what we've seen in the aftermath is we've seen a couple consolidations to get smaller, to reduce the overall risk management and be able to operate in a coherent way. And I guess my concern is JP Morgan can only take on so many of these banks, right? And so this idea of consolidation going forward really will impact disproportionately the areas of the economy that are underrepresented and underserved with respect to basic banking services. Now, we just had a quarter where the economy grew by 5.2%, productivity was 5.2%, consumption was at 3.6%. But if you decompose it, say state by state, what you see is California did all right, Texas did great, Pennsylvania did good, Florida did good, New York barely there. But when you look at Alabama, Missouri, Arkansas, not so good. Where do a lot of these banks serve? They serve these places, right? And the reason why I wanted to bring this up is we're at a unique moment where populism's on fire around the world. And the idea that we're going to see broad-based consolidation over the next decade during a time when people who are upset that they've been left behind won't have access to basic banking services seems to me to be a bit counterintuitive. Therefore, in order to retain that system, we're going to have to take another look at the regulatory framework and the financialization of some of these institutions. right? Because they're going to need more sophisticated risk management in order to navigate this period of time as those held to maturity securities are going to sit there on the balance sheet. And we get to the new equilibrium, wherever that is, in terms of the neutral rate and the long-term rate and where we think mortgage rates are going to be.
So if I could just pick up on a bit on this issue of consolidation and how that affects different regions differently. I think another important thing to point out is that there's fundamentally different business models of the large consolidating banks like the JP Morgan and the regional or community banks. And that this business model also, this difference in business model also translates to a difference in funding costs. So recent research by a colleague of mine here looked at the sort of cost of raising deposits for community and regional banks versus the JP Morgans of the world. The JP Morgans of the world are able to issue deposits at very low rates, and the regional banks have to pay more on deposits to compete more to get them. But at the same time, the JP Morgans of the world are focused on serving the urban markets. So if you just look at where they locate branches, they don't locate branches outside of dense urban centers. The rural or suburban markets are more served by community banks. And we have this kind of divide in both business model and how they provide credit and also funding costs regionally that I think is concerning, and I'm going to need some type of regulatory reform in order to support these regional banks in order to make sure these communities have banking services. And I think this is also a place where credit unions can serve a very important role, right?
We do a very good job in that area as an industry. We look at desert banking areas and we have certain restrictions around field membership. And so we serve the underserved, and those are marginalized probably better than any other charter out there, in our opinion. That's a pretty strong statement, but when you consider about the not-for-profit nature of what credit unions do, it makes a little bit more sense about how that can be incentivized as a business model. I don't think the consolidation is a new trend. I mean, at the turn of the millennium, we saw over 25,000 banks and credit unions in the world. Now we're tracking to less than 9,000, and next year will be less than 8,000. So this is an ongoing trend. Our forecast is that we believe that we're going to see less than 3,000 banks and credit unions over the next 10 years. And that may be rapidly accelerated based on Joe's comments as well. So I do think it's a trend to be concerned about. You think about the fintech space, about how that's affecting mainstream banks, and you look at 47% of all checking accounts last year were opened by a fintech, not necessarily by a traditional bank or credit union. So there are some other pressures outside the economic macro kind of pressures on banking institutions. And I think overall, though, I think competition is going to provide the consumer and business with a better option, with a better choice.
And let me, the competition, over the last couple of years, this private credit business has sprung up out of the unregulated community. We're going to have a maturity wall of corporate debt that's going to come due over the next couple of years that probably is between 3 trillion and 3.5 trillion. In order to sort of put your hands around that, so the 5-year vintage corporate debt taken on in 2020, let's say $80 million at 5%, it's going to roll over in 2025. But the banks are going to say, not so fast, my friend. We'll give you 50 million at 8%. Okay, that creates a 30 million gap. Okay, normally, in past cycles, local regional banks would step into the filled gap. They're not right now. It's happening in this new private credit business, which has gone from a very small area, very small corner of Wall Street, to a $2 trillion business. It's to the point where chairman of UBS was whining about it a couple of weeks ago, saying that should be our business, right? And whether it's an $8 million loan at 5%, an $80 million loan at 5%, or an $800 million loan at 5%, when those loans get rolled over, there's going to be a gap, right? And it's this competition from these new unregulated areas of the financial sector that provide both risk and opportunity. And it's just part of the new landscape. And again, this isn't something that we've really seen before. This isn't private equity, this is private credit. It's a brand new area that's going to create some pressure on the margin for these financial institutions. And I think it's something that if you're interested in American finance, if you're interested in banking, if you're interested in growth for that matter, this is something you want to pay really close attention to going forward into this 2024, 25, 26 27 as these 5-year vintage era loans are rolled over.
I would like to just introduce the concept of, you know, ease of access. And so when you're talking about highly regulated financial institutions and how they are able to create credit opportunities for, and in my instance, I'm talking small business in general. Sometimes, again, you're talking about credit card usage and you see this credit card usage go up. Why? Because it's easy. It's easy access and it's available. And they don't have to go through the mounds of paperwork and or possible decline out of the bank because they don't meet the credit window, the credit standards of the banking system. That is a problem, and that creates opportunity for the unregulated lenders. And you know, in addition to that, for some of the small business and those that don't have access to, the prime interest rates, they will pay more just because it's easily available to them. And so then you have to look at what happens, to those businesses when they're paying higher rates for their money just because they don't have access to credit otherwise. That's an issue.
Yeah, and just to pick up on that, my reading of the private credit market is that it's been very effective at underwriting these, I don't know if you would call it middle market, but the sort of the 50 million and above loans.
Yep.
But underwriting the loans for small businesses, it's a little bit more difficult, and so maybe the scale just isn't quite there for these private credit lenders to step in, and that's typically been the role of the community and regional banks, especially because they also have local embedded knowledge, right? And if we lose that, we risk losing a key part of the business dynamism in the US. A lot of small businesses start small and end up big, and with funding from local and regional banks. And so I think, from my perspective, I think the private credit market is actually kind of a welcome development for corporate America. Maybe it provides some immediacy, but it could be concerning that if it kind of squeezes the lending market away from small business lending, we could see an impact on growth.
Right. And you've talked about sort of the differential effects in different regions. Do you see, as you mentioned, we know small firms rely more heavily on small banks. Do you think there are going to be differential effects in different industries? So some industries will be more credit constrained than others, or is it pretty broad?
Well, no, I think clearly that's a case, right? Citizens Financial is trying to move in and get SVB's business, which is very lucrative. Just walk down the street in Menlo Park. It's pretty easy to figure out. But if you're in the old, what I call traditional economy, that deals with the old smokestacks, they're going to not have the privilege that those who are affiliated with artificial intelligence and the broader technology community are. I mean, look, if you followed NVIDIA this year, that's the #1 performing stock. It looked to me like around $2 trillion flowed in there in a short period of time around NVIDIA and its ecosystem. You have a Bloomberg terminal, you can look at the supply chain and see where all that money went, right? Yeah, if you're not affiliated with or have access to those ecosystems, you're not going to have the privilege of getting easy money. And this is a ripe area for discussion around policy and regulation.
Which is a great segue. Did you want to add?
No, go ahead.
Okay, which is a great segue. And we've mentioned regulation has come up several times because it's top of mind. We know that, Basel III, the so-called endgame reforms are under discussion. Wall Street has been very critical. What are the prospects for new regulation, and what do each of you think is important for the new regulatory atmosphere to include?
Well, I think the prospects of new regulation in the election year are quite well. And depending on the configuration of power in 2025, that will largely dictate whether Basel III is actually implemented or not. My sense is always when you have these, we went through 2 large shocks in the past 15 years. The regulatory system needs an overhaul that's appropriate for the new structure of the economy. And of course, that's not easy. It's easy for panelists like me to say those things. I'm not an active elected actor, nor am I a policymaker, thank God.
I have a few things to say about that.
I bet you do.
Yeah, I mean, so as a state charter credit union, we have to comply with 22,896 regulations in the state of California. That's just the state of California. There were 1,400 new amendments, new bills have been proposed to regulate financial institutions in the state of California for next year. So yes, although at the federal level, definitely the international level, we're not going to see Basel III kind of make any type of significant headways because of the election year. Regulation is still happening, right? Whether it's AI or whether it's the California Consumer Privacy Act or whether it's the agency that's being stood up to help support and administer that in the state of California, it continues to come at very high rates. And so I do think that we're seeing regulation happen. I have never seen in my career, though, the kind of collaboration we have with policymakers and the practitioners, which is really cool. Typically in the past, it was kind of adversarial. There's a lot of discussion, debate back and forth. There was a lot of waste in the process. And now it's much more collaborative, especially in the state of California. And I've been in 7 different states working with regulators. So it's very encouraging, I think, about how thoughtful and meaningful policy will be implemented going forward.
Yeah, I mean, so I think there should be a focus on ensuring that regulations aren't imposing unnecessary fixed costs, which are going to lead to more of this. This is the sort of the story of consolidation, is if we have regulations that that have high fixed costs, the incidence is going to be borne primarily by smaller institutions in the system, and so larger institutions are going to be able to and bear those fixed costs. And so it's heartening to hear that there's collaboration between regulators and practitioners to reduce those fixed costs. I also think that, I mean, we're at a change in the technological landscape. I think we could see some real innovations in how these risk models are evaluated and how they're implemented in terms of data collection and management in the future, that give me some hope that maybe we can get rid of some of these costs. But that's 20 years.
So my perspective is I started in banking in the early 1970s. And over each decade, this has been a topic of conversation. And it has grown in, volumes over that time period. Back in the early 70s, I think we were dealing with truth and lending, and that was pretty much it. And I think it was in the late 70s that they decided, you really should have a compliance office. And then it began to escalate from there. We went into the times of 18% interest rates, and we've seen effectively zero, negative. And so the system, believe it or not, is actually pretty resilient. It is actually stronger today only because the regulators have enforced, and rightfully so, higher capital standards for the banks and more sophisticated risk models. So even if you're running a small community bank, you have to have these things in place, not to mention all the other risk factors that come with the Bank Secrecy Act and the technological risks and all of the things that you have to be aware of within your bank. But the fundamental business is actually basically pretty strong compared to years past and decades past. And I have a great confidence in the fact that we'll continue to do so. Consolidation, over all of those years, we have seen periods of consolidation. That's part of the cycle of banking. We've gone through, you see a lot of startups, and then you see none. And then you see the acquisitions, and you see that there's suddenly no small community banks. But in years past, we would see, or in time periods past, we would see then, the growth of those new de novo banks coming up. We're not seeing that now. And that, I think, is an indicator. And just as we've said, that creates a risk to, a very large segment of the population that are looking for, access to someone who's going to understand their business, it's going to understand them, and isn't just looking at them, as a risk factor. So, I'd like to see that there would be some, yes, we need mass revision, complete overhaul of the regulatory system. Just imagine if for every new banking law that was passed, one went away. We haven't seen that happen. And we definitely don't see that in California.
So in a minute, I'd like to open it up to questions from the audience, but of course, artificial intelligence has come up in this conversation. It comes up in every conversation these days. How should we think about, or what are your thoughts on how AI could be disrupting the provision of banking and financial services?
At University of Creighton, we love artificial intelligence. We think that it's going to allow us to scale at levels that we couldn't see before in the past. If you looked at growing a certain number of members or a certain number of universities or a certain number of branches, you would have to staff by X number of employees. And there's a certain ratio you try to target that's based on industry standards and benchmarks. But with AI, it's now we have something that can serve 24/7, 365 with unlimited capacity on a second by second basis. And so we've leveraged AI both on the member facing side and employee facing side to increase efficacy and speed in service to our member owners. And so when you call our call center now, you're talking to AI. When our employees are looking for an answer to a question or a procedure, they're asking AI. They're not looking at internet anymore. There's no longer going to those types of resources. So the speed, the efficacy, all that's being happened in real time in a way that we've never seen before. During COVID, we saw our contact center get affected quite dramatically. And because of AI, we were able to stay and meet our service level. So we never did see that drop, even when our call center was down by 80%. And that was 100% because of AI. It is the great enabler of competition. There are concerns for sure at the regulatory level, at the FAD level in the state of California. We are talking about, intelligent regulation around AI, but it is a fantastic tool for us. And we've been leveraging it for over 4 years now.
Well, so I see the risk is two-sided. So when I think about AI, I think about machine learning, that's the first pillar of AI, that which many of us can already do. The second, which we're just sort of learning about, is generative AI, which to me means large language models. And the third pillar, which is called artificial generalized intelligence, is about quantum computing and AI. And the discoveries are Q-star, which you're hearing about from up north at OpenAI, right? My sense is that you're going to get better credit allocation for the great big firms around the big economies that serve the metro areas. But the other risk of that is everyone else gets left behind, which necessitates, from my point of view, the support and maintenance of local and regional banks who are in touch with the true credit conditions in these local areas and the balance sheets of these banks. Because if we leave it to AI that we don't quite understand, I'm not certain that the allocation of credit may be more efficient, but not optimal.
So are there any questions on the audience? Yes, please.
So I have a question around regulation and sort of how it's evolved. If we look at the GFC, what came out was basically, say, the G-SIBs and Basel III, right? Globally systemic investment banks, where basically the regulator of the country jumps in if there's a blow up. So essentially they can't default and they're going to be heavily regulated with Basel III. So that basically reduces the risk of default. It also reduces their cost of capital. But in the meantime, it makes them able to compete even more against those regional banks. And those regional banks, because they have to compete on deposits, are getting their margin squeezed. So the two outcomes of that seem to me, and it's going to be a little controversial on purpose, is the regional banks get squeezed completely out. They have to consolidate to G-SIBs. Jamie Dimon just waits for all the regional banks to blow up so he can get them on the cheap. And then the corollary to that, because they can't take on all this risk, is that a lot of the economy moves to the shadow banking system into private credit. I'd love to get your thoughts on it.
I mean, I'll weigh in a little bit, and Joe probably can speak to this more than I can because we're now operating the international side of the business. But when you look at even just what is defined as a systemically impactful bank, it's the numbers going up. And so you look at the latest interchange bill that's currently being proposed to eliminate credit card interchange, the same way that was done to reduce debit interchange. You're seeing that number now is going from 10 billion to 100 billion, right? And so depending on how we define regional banks, and as we mentioned earlier, I believe you said it was like 10 billion now is the kind of the threshold. Maybe regionals do still have a play, but I do think that from a localized model, you're seeing success. I mean, we've been around for over 72 years and have weathered all kinds of different types of regulation. But I think as those get larger, I think maybe the shadow banking area you talk about is more the community and banks and credit unions that continue to thrive in that environment.
Real quick, when I was younger, I read a book by a guy named Thucydides. And I learned something called, or a phrase I always remember, that the strong will do what they will and the weak will suffer what they must. The current state of our economy, embedded in a changing global economy, requires that we have systemically important financial institutions that can't fail. It's just an unfortunate byproduct of where we're at. So there's going to be an inequity. It's going to be unfair and it's going to be not well balanced. But that's not going to go away anytime soon until we address the fundamental question of how we want to organize ourselves first. But that's essentially a political question, not just a financial and economic question, which is why I started with Thucydides.
The spread that you talked about, the risk spread of 800 basis points? Give or take.
300 basis points, yeah.
Oh, 300 basis points. I thought I heard 800. Over the, what is it, SOFA?
Oh, you're talking about, yeah, the risks.
We're taking that
800, yeah.
Yeah.
So my question actually revolves around this notion of private credit, because I was actually at a small $2 billion bank, maybe about 2 months ago. And they were bringing in people to help them figure out what the bank's role ought to be in private credit. And what that tells me, having been a former banker, that most people get out of these deals with debt substitution. And so if you're into these deals and you've got a risk premium of 800 basis points, how do they get out? And is that just at some point the big haircut that you talked about? Where's the money coming for the haircuts?
Small and medium-sized firms are inherently risk managers, and they'll roll it forward.
Unregulated people.
Yeah. You asked the question.
None of you spoke about money market funds as competition. $5.2 trillion, probably up over $1 trillion post Silicon Valley Bank and post a rise in the short rate. But the thing is, that just puts upward pressure on deposit rates across the whole system. And my guess is this time it's going to be stickier because one the money market funds are mostly treasury and agency securities. And you don't have to worry about bad real estate, bad this, bad that, marking to market, all kinds of stuff, because they hold 30-day, 60-day paper. So what does that do? What kind of pressure does that put on the banking system?
I mean, I think for the first time in my career, we saw competition in treasuries beyond money markets. You know, we saw people that were looking at moving from insured funds to going to treasuries, right? Very safe instrument. And so from a money market perspective, it is putting pressure, upward pressure. We continue to raise our rates on our high yield savings account in money markets, and that is putting tremendous pressure, as that is the third largest funding source of the balance sheet for us. On the vice versa side, right? Like there's other instruments that on the asset side that are floating that are duration matched to that particular asset class. So we're at an immunized position there, but it does put risk as far as the dollar goes. We do think that we're going to pay more for less in the future, as far as more in cost for less dollars that are coming in the door. But one thing that also hasn't been brought up is also the embedded finance and the nature of, like, let's say Starbucks or Venmo, where people are leaving billions of dollars in those apps uninsured, right? In an unregulated way, thinking that it's safe. And maybe it is, maybe it isn't. But that is an equal threat to deposit base as well.
Jerry's the boss.
Okay, last question.
Just a simple one. I heard that large banks can afford to offer lower deposit rates, which may be true of the large corporates, but as a regional banker, I don't see that in the regional markets. That's not my experience anecdotally. So I'm just wondering, is there some kind of difference? Because they do compete on the regional basis as well, and their deposit rates are actually usually very difficult to beat.
Yeah. So this gets down to which branches are rate setting and which are not. And so I don't want to get too far into the weeds, but just if you look at the data on the costs of providing deposits, or alternatively, the interest paid on deposits, the banks that have more branches in urban areas just pay a lower cost. So I'll point you to a recent working paper by my colleague, Andrea Eisfeld, for the particular citation of the data, but this is taken from using a data set called the Rate Watch data set, where we aggregate interest paid on deposits across the banking system. And that the key stylized fact is more branches in urban areas, lower deposit costs, which is, we think, puzzling, right? Because you might think that those are more sophisticated consumers who are more willing to move their deposits around the banking system, go into treasuries or money market mutual funds. But at the same time, we think that those consumers are also demanding a lot more services from their banks. You know, they want to effect more wire transfers. They have more sophisticated credit needs. So it's not necessarily clear that there's a higher margin on that lower deposit cost, but that's what the data are saying. So it's interesting that you're not seeing that anecdotally. And I think this is probably a little bit to how the interest on deposits is set at the branch level across different larger institutions. So the larger institutions that want to compete with you as a community bank realize that they have to have the flexibility to offer different deposit rates at different branches. And so, unfortunately, they're making your life hard.
Would you say that's also a factor of the deposit mix? So if they have a larger pool of demand deposits, their cost of rental.
Clearly. Now, clearly, we could use another half hour to an hour with this amazing panel, but we don't have that. So please join me in thanking Lori and all of our panelists for a really informative session. And I want to thank you for joining us in an unscheduled fire alarm. You did well, you passed. But before we close, if you just hold on for a minute, I want to thank our sponsors again, because we could not put this event and our other events on without our sponsors. Our principal sponsors today, RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors, the law firm of Allen Matkins, California Bank and Trust, Cafe Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, Pacific Western Bank, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Comerica Wealth Management, Hathaway Dinwiddie, Scott Work North America, US Bank, Private Wealth Management. At the bronze level, Hanmi Bank and HDR and Shawmut Design and Construction. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, Federal Home Loan Bank of San Francisco, and Tudor Perenni Corporation. Many thanks to them. Our next program will be the 13th of March, and our theme is going to be AI. Of course, AI is dominating everything. AI and the business of entertainment. And we'll be talking again about our latest economic forecast. So we look forward to seeing you there. Drive carefully. All those people who are now working in California are on the 405. Thank you, and look forward to seeing you in a couple of months.